everyone, welcome back to the Future of Finance podcast. I'm your host, Marissa Wood, one of the owners of Union Financial Services. And today we have a great episode ahead where I'm going to sit down with a client of mine, Jeremy Hicks. Welcome, Jeremy.
Thank you, Marissa.
And I think for all of our millennial listeners, you're really going to like this episode because Jeremy and I both are millennials, and we're going to go through some strategies that we're using to help millennials actually see that they can retire one day and they can not just survive in retirement, but really thrive. And all the steps that lead us to that point, whether it be paying off debt, vacationing more, enjoying time with family more throughout the stages of life, and how we're helping you and your family do that, right?
Absolutely. One of the things that attracted me to become a client of yours was how you were like, it's my goal, like, to help millennials understand how they can retire. Because I felt like most financial advisors just talk about retirement as if it's like same old, here's the strategy. But when you came forward, we're like, no, there's a different strategy for millennials because of how things are going. And that's kind of where I want to have a lot of my expertise, almost be my niche. And I was like, I can get around that.
Yeah.
So
it's an underserved market. It really is.
Sure.
Because especially a lot of advisors will look at the millennial demographic as, well, you don't have a large enough amount of assets yet, or you're too far out from retirement, or you still have too much debt to pay down first. But that's not true. We need to start somewhere and build upon it eventually.
I think up until probably a year ago, it was always millennials do not have money. And now it's like we're in our 30s and it's like, okay, so millennials should have money. Where is it? I think it's almost like that's where it is.
Yeah, all of a sudden you're in your 30s and you're like, okay, it's time to really get down to this and start building up some wealth, or else I'm going to be in big trouble.
And I don't mean to come from like I'm a victim of anything. By all means, I do believe that we have plenty of opportunity to make money, grow investments and stuff like that. I don't want to make it sound like we're in this terrible zone, but there is a reality that where I have always felt, as when I talk about me being a millennial, it kind of comes down to this. The strategy we were told to follow, it seems that every time we begin to follow it, it changes. That's, to me, what it has felt like. Like get your career, go to college and get your career and start that pension, start that retirement plan. Well, when I graduated high school was during 2008, was during that time of there's no jobs. College was like we're told to go to college, but then what was afterwards? No one was getting there. I think a stat I heard from my wife just randomly said the other day was like 10% of people are doing the job that they actually went to college for.
I believe that.
So it's like, just that strategy alone hurt. And now it's the housing strategy. Now, I'm very lucky to have gotten a house when I was only 25. Actually, I was 24 at the time.
Me too. When I bought my first house.
And I remember,
but that's rare now.
It is extremely rare. Yeah. I'm extremely lucky. I'm still in that house.
Yeah.
I can't seem to get out of the house now, but that's a story for another time. Yeah. But the reality is I have one, and I'm one of the very few. So with all that being said, I just want to say, like, I'm excited for a lot of things you're showing us, teaching us so far as a family, but with the reality of, it's not exactly how my parents have retired.
Not at all. And I think, a lot of us feel this hopeless. And I know you expressed that a lot of your peers have said, I feel like it's a waste. Why even bother? I'm never going to be able to retire, or I'm never going to be able to buy that next house because there's so many other expenses, and there's high inflation right now. The pricing of real estate is outrageous and everything else. And so it feels like, well, why even bother? But that's not true. There is hope. There is strategies. It's just a matter of starting small. And really, these small changes can make a huge impact in the long run. And that's one of the things I wanted to discuss today is an exercise that we did recently for your family, which we call the retirement analyzer, or a future cash flow projection. And it's really good for people that are visual learners, which I am a visual as well. It's nice to see it. We can all talk about numbers all day long and most people's eyes will glaze over. But when you actually see the impact of, if I save this amount per month for the next X amount of years, what will that look like in the future? Is it going to be substantial? How can these little changes now make a huge difference? Will I run out of money? And so on and so on. And so tell me a little bit more about what that process was like. What kind of information did I ask you to provide for me in order to input that into the software?
Really just our income and expenses, first of all. That's really all you asked. And then like anything that we do have, right? Naturally.
Expenses, get more into that because most people have no idea what their expenses are.
Yeah. So I don't know if I made things harder or easier for you. I try to keep track of our expenses. I personally use Rocket Money app.
Mm-hmm.
So when it comes to expenses, our mortgage, our so our hard expenses. So any of our bills, like they're like
utilities,
this has to be paid. Mm-hmm. And then there was the budget of like, okay, here's what we normally spend on groceries. Here was what we would normally spend on dining out. Things like that. Mm-hmm. So it was like expenses plus the expected expenses of budgeting and stuff like mm-hmm. that too.
Which most people have no idea what they truly are spending. And you were pretty close because you have a good sense of it and you were already using Rocket Money. But normally when we do this exercise with people, I'll give them the spreadsheet to input what they're spending on utilities, what they're spending on gas, dining out, groceries, shopping. And it ends up being way more than they had anticipated it. Mm-hmm. And that's okay some months, but then if it's consistently that you're spending $2,000 a month dining out, that's glaring. Let's start bringing that back a little at a time.
That's a heck of a budget.
No kidding. No, and I've seen it. I'm telling you.
Wow.
Yeah.
What are they going to Burns every weekend? Like, what's going on?
I know. And so it helps those certain expense items stand out if they're out of the ordinary, and I'll bring that to your attention. Hey, this is something we want to focus on moving forward. But then ultimately, we can't do any kind of planning if we don't know what you need to cover on a monthly basis. We have to work backwards. We have to know what that number is so that if there's a deficit in your income versus expenses now, or we think there's going to be in retirement, we can prepare for that.
I was curious to know also, like, how you figured out what our expenses would be in 30 years from now. Right?
Yes.
Because that was jarring to see that. I'm like, I'll let you know the number.
So we use some inflation, which we use an average of 3%. Mm-hmm. And we've taken that from the past 20 years. There's obviously going to be some years where we saw crazy inflation during COVID times. And then the average is about 2 to 3%. And so that's what we use to forecast out. Okay, if your bills are $8,000 a month now, believe it or not, by the time 30 years comes around, that same $8,000 is going to cost you about $20,000.
Yeah.
And most people don't assume that, but we have to plan for it because we know, we've seen even the last couple of years, the cost of living just keeps going up.
Yeah.
And that's also the importance of having your money invested and earning for you so that you can keep up with that inflation.
Yeah. It's something I've noticed, over the last 15 years of truly being in the workforce, I guess you could say. I'm being 35 now. Investments typically, on average, grow, but your salaries don't.
Yeah, and that's another trend that we're seeing actually among millennials. It seems like people don't stay at their jobs unless they're self-employed. They don't stay at their jobs as long as they used to because they're not having a pension that they need to stay vested in. And raises are not really keeping up with inflation in most industries, which is a shame, especially in Florida. They're not really adjusting those salaries as they should be. And so what's happening is people are going to a different job in order to get that raise. Their starting pay is then higher. And that's good and bad. That brings us to another topic of when you do leave that job, you don't want to leave your 401k behind. Mm-hmm. We call that the forgotten 401ks, and we see it all the time. that we'll be sitting down with a client and they'll say, well, I think I have $1,000 here or $2,000 here at that employer, and I forgot all about it. I don't even know who's managing it. I don't even know the balance. It's so common, and it's a big problem for a couple reasons. First of all, is it being actively managed? Is it performing optimally? Mm-hmm. Second of all, is all of your information updated? Are you keeping your address up to date, your beneficiaries up to date? If you forgot about it, the answer is probably not. And then third is organization and the ability for you to have more control. You can choose where it's invested. You can choose how many fees you're paying, because in 401ks, there's a lot of hidden fees that people have no idea exist. And by moving it into an individual retirement account, an IRA, and consolidating it with all of your other old 401ks, we can take control of where it's invested, how it's performing, what the fees you're truly paying are. It's probably one of the most common things I see when doing this exercise with people is forgetting those 401ks.
I actually don't truly know the difference of a 401k versus like
an IRA.
I mean, I know the difference between a traditional and a Roth, but I don't know the difference between a 401k and an IRA.
So there's not a huge difference. Really, the only difference is that a 401k is employer sponsored. Okay. And so they're putting it together. They're usually giving you some kind of match, which is the whole reason to even contribute, is if you're getting a match. And they're having a third party usually manage it and pull it out of your paycheck every 2 weeks. But an IRA, it's the same in terms of taxing, that everything you contribute is tax deferred. It saves you on taxes, tax deductible. It saves you on taxes now, but then in the future, you go to withdraw it in your tax.
So a 401k is basically almost always traditional.
Yes.
Yeah.
We hardly ever. I mean, they are becoming more popular now, but the Roth 401k, it's usually not offered as much. And the reason why is because, I hate to say it, but most employers, they're only giving you that 401k to save the company on taxes.
Yeah. Yeah. Which something is better than nothing.
Yeah.
Yeah.
But if they're giving you a Roth, that's not saving the company on taxes now. And so they usually won't match any kind of Roth.
Right.
Sometimes they will. I mean, if they do, then that's great.
Right.
But usually not. So yeah, 401k, IRA, 403b, they're really all the same thing. But the importance is moving it to that IRA once you don't work there anymore.
Yeah. Yeah. I know that my wife has one that like she was laid off in 2020 when a lot of stuff was going on. And she has maybe a couple grand somewhere. And when we had another financial advisor before we met you, it was like, yeah, just give them a call and transfer it to me. And my wife's like, I don't even know who to call. I don't know what to do. And then during our retirement analysis, you're like, I can do that. And I think we almost like want or expect that from a financial advisor. Like, we know what to do. And I'm like, isn't that the whole reason for a financial advisor? So I appreciate that about you.
Well, I mean, it's a cumbersome process for the average person to do on their own, which is why people just leave them and forget about it. Whereas we do it every day, and the process is easy. Step one would be open up a new IRA that's only in your name, has no company attached. And then we talk about where it should be invested, which funds it should hold, how aggressive it should be for your age. And then step two is initiating that rollover. And that's what we help with. We'll call you with a 3-way call. We'll call the old employer 401k plan. It's not actually your employer. People get worried too that, oh my gosh, if I left on a bad note, I don't want to have to call my old boss. It's not like that. We're calling the actual holding company, whether it be Fidelity, Vanguard, Empower. That's who we're calling. We're not calling your old employer. And then that initiates the rollover process. We'll call them and say, Jane Smith now has an IRA held at this company, account number 12345, and she would like to roll over her money that's in this 401k into that IRA. Here's where you mail the check. Here's the account number to put on the check, and that's it. And then we help them deposit it in, and then it's done. So it pretty much is simple once you know the process and once we're there on the phone to guide you.
Yeah.
But the average person, yeah, it's like, where do we even begin? And so that's the importance of rolling over the 401k and kind of the process on how we help that to be completed from step one to completion. And so the other thing that we addressed during our retirement analyzer is, when do we think we're going to run out of money in the future? And that's such a big question mark, especially for people in their 30s. You know, there's so many things that can change from now until then. But let's say if, you know, we plug in all the data with a client and it takes them to age 75. That's when they think the software thinks that your assets will last you. Can you tell me about a couple of the small changes that we were able to make in seeing, okay, if we make this change, it'll now take us to age 80. Talk me through how that process went for your family without using real numbers.
Yeah. So it was nice to know that we had enough money to last us at least a little while, at the rate of, you know, much, like basically twice the amount of expenses, with the inflation and everything like that. So it was like, okay, it's nice to know we're somewhat on a route, because we have not been like really actively saving. We've only the last few years have we actually been to that point. So knowing the numbers now of like, oh, if you do this, it should last you another 5 years or something like that. It's like, okay, we can do that. I think I can focus on that right now to last us another 5 years, and hopefully in the next 5 years I can do another amount for maybe another 5 years or something like that. So, you know, I am curious, what do you normally say is where you want it? Like, do you want 20 years from 65? Do you want 15 years from 65? Because there's other strategies, right? You cut down your expenses too, like paying off the house.
Of course.
If you don't have a mortgage, that helps you last longer, right? But
so you're saying, what age do I want to see people get to? Well, you know, it's tough because now the average lifespan for a woman is about 86, 87. The average lifespan for a man is 82-ish. But that's now. People are going to probably live longer 30 years from now, maybe. I mean, I'm guessing.
Yeah.
But, you know, we might want to project out into the 90s, in my opinion, because yes, some expenses will come down in retirement, such as maybe housing. Eventually, you're going to be traveling less once you're in your 80s. But when those expenses come down, guess what goes up? Healthcare.
Yeah.
You know, and prescriptions, and maybe paying someone to help you around the house.
Like almost, but if you're getting up to 90, you're probably wanting to go to a retirement center, which is pretty expensive. You know, it doesn't even matter if your house is paid off.
Yeah, so I don't ever want to assume expenses going down. If they do, then great. Then we're going to have extra money. But I don't ever want to assume that in our calculations. And, you know, it's just cool to see, I think, back to that hopeless mentality of millennials, that even if we just start contributing $100 or $200 extra to our investments, whether we open up a Roth or whether we start taking advantage of a 401k at work, what those impacts can be in 30 years. $100 or $200 now consistently could literally buy you 5 or 10 more years in retirement. And that's crazy to see, but isn't it kind of uplifting?
Yeah. It's hard to think about in certain ways too, because it's like, not that I live in sort of a like YOLO situation. Like I don't like thinking that way. I want to leave something for my kids. I got 3 kids, and I want to give them a little leg up when I go, and they're going to be heading into their retirement ages and stuff like that. So even if I'm buying myself another 5 years that I don't live for, that goes to them.
Yep.
So that's also the way I look at it, is not just investing in your retirement, you're investing in your kids in that situation. And something that my wife actually brought up after our meeting, she said, oh, you know, this gave me some hope and everything for retirement. But man, it makes me feel like I'm not really leaving much for my kids, you know? And I'm like, us retiring or paying for retirement is helping our kids.
Yeah, believe me, they don't want to be taking care of you.
Yeah.
Yeah.
So, that's
But
sort
you
of the
are doing stuff for your kids because you have insurance in place. You have life insurance.
absolutely, absolutely. I mean, but that's how I'm kind of looking at it,
Yeah.
right? Is how investing in retirement is investing in my kids actually.
It
you
is.
know? So that's helped give me a little bit of peace of mind of, I could really, I like to kind of keep this, $500 or something like that, towards something really cool or something like that. Or, I'm afraid of investing it because putting in a Roth, it kind of locks it up for a little while.
Yeah.
But first of all, you gave us some other strategies, but also, again, I'm investing it toward the future,
Yeah.
so.
Yeah. And I mean, using that $500, the average person, millennial, might have an extra $500 a month to put towards investing. And so that's a conversation that we can have. Well, where should that go? Splitting it up into different investments. If you have that $500, it doesn't all need to go towards a retirement account. I actually don't think it should, especially for those in our 30s and 40s. We do need some money for now and for 5 years from now. And so maybe out of that 500, 100 can go into a really, really short-term investment, maybe a money market or a high-yield savings account or some kind of brokerage account that you can get to immediately and, pay your next 6 months worth of vacation costs or, maybe you buy a new couch or something. The absolute now money. And then maybe 200 of it goes towards an account that maybe is a joint account with your spouse that you're using for a down payment on a house for 5 years from now. That's like the still short-term money, but not immediate.
Yeah.
And having it invested, that's a huge mistake too is okay, I'm going to earmark this $200, but I'm going to leave it in the checking account.
Yeah.
Earning nothing when it could be earning 7, 8, 9% if it was invested.
Yeah.
And then with that last 200, maybe we put it towards the Roth IRA that we're not going to touch until we're 60 years old. And we're going to really let it grow. But regardless of what you have in excess every month, whether it be $100 or $2,000, it really should be split up between different time categories and types of investments.
Right. Yeah. How do you help people diversify?
Well, it's all about, what are your goals? We'll have a conversation about, is your goal to buy a new house? Is your goal to spend X amount on vacations every year? Do you want to be very aggressive? Would you rather just see that slow and steady couple percent a year and not lose your money when the market has a downturn? And so there's no one size fits all, but you don't want to have all of your money designated for retirement because then you're in big trouble if you have a big expense come up. Then what,
Yeah.
And
I think a lot of, I don't know if it's my generation or maybe just a circle of people I've been around sometimes, there seems to be two different views of financial advising. And from my experience, when you come from a wealthy family that had a financial advisor, you think about getting a financial advisor regardless. But when you come from a family that maybe was like barely, like the only retirement they have is pensions and stuff like that, they never really had to have a financial advisor per se. You think of a financial advisor as for someone who has a lot of assets. But you come to the picture. First of all, that's not what a financial advisor is, everybody. But you come into the picture like, I will help you with whatever you can get or do, and then we'll figure out a plan. That's what I've really enjoyed about you because everyone else is just like, how much money can you put down? Because that's just put as much money as you can. It's like, okay.
Yeah, because that's not real life.
Right.
We're all going to go through phases where we have a lot of excess money and sometimes we don't. But it doesn't change the fact that you are going to need some guidance throughout each phase. And going back to that, well, what do we need to start putting aside if we have a little bit of surplus every month? And will that make an impact? Because I guarantee you, someone just saying, yeah, I can put aside $300 a month, they might do it for a little bit, but if they know that that $300 a month, them putting aside, will give them $2 million in retirement, they're way more inclined to do it because they see that those small changes can make a big impact.
A big regret of mine is just I should have just given $100 a month starting at 20. I probably could have afforded $100 a month for the last 15 years. But I felt like it wasn't enough to make a difference.
Yep.
any little bit counts.
So that's a huge message for anyone listening to this. Yeah. A very small amount and just starting is probably the best thing you can do for your future.
Yeah.
And so overall, going through that exercise with you and Morgan, did it open your eyes to anything that you didn't know about, or did it make you feel better about the future? Did it make you feel more scared? I mean, you can be honest. Did you guys have more conversations prior or after that meeting?
Yeah, again, it kind of came down to, like, I think if we didn't, I don't mind sharing a personal thing here.
Okay.
If we did nothing, like, outside of what we're doing right now, like we didn't raise it anymore or just only what we have right now, we could likely retire it. I think you said 75 or 80, one of the two.
Mm-hmm.
And at first I was
no,
like,
run
wow.
out of money, not retire.
That's what I meant. Sorry.
This is retiring at 65.
Run out of money.
Yeah.
We'd run out of money by 75, 80,
Yeah.
if we, again, with the current expense and stuff like that, there's a lot of variables with that. But I was like, I think it was 75 at first. And I was like, okay, that's really neat. And all of a sudden I was like, oh, wait, that's only 10 years.
Yeah.
Yeah. So it gave us hope that, like, oh, we're better than now than I actually thought we were. If we have 10 years of retirement at that amount of expenses that you showed us, okay, that gives us some hope and some strategies to now work toward. And so now it feels like we know what we're doing when we're investing, rather than just being like, hopefully it works. I guess there's a little bit of that too.
Yeah.
But, yeah.
Okay, that's good. So it gave you a little bit of clarity and hope.
Yeah.
Now, another question that I've been asking a lot of our guests is, what is the best financial decision you've ever made? And what is the worst so far in your life, if you don't mind sharing?
Yeah, so the best financial decision I ever made was actually buying a house at 24, which I was really reluctant to do at the time. And I remember thinking to myself, like, this mortgage is too darn high. We should have gone lower, blah, blah, blah. And now I'm like, I have the best mortgage ever in comparison to everybody else. So I'm like, all right, well, I lucked out. I lucked out for sure. So that was the best financial decision in my life, was getting a house at the age of 24. It's like, well, I didn't do really good on retirement plans, but at least I got that in my, my Rolodex, and which is good, by all means. So there's that. And I'm a little shy to even say that because I feel super, if I was 24 now, I want to be able to, and I feel like super bad about it. I feel bad for others. I empathize. I empathize. It's not like I got lucky. But if I would have waited just 2 more years, so for everyone listening, there's risk all the time. So that was my best financial decision. My worst was actually buying solar.
I knew that was coming.
But let me give some context.
Okay.
It was, first of all, I don't think that solar is bad for your home. I don't think it's a bad investment, but I do believe that there are a lot of bad companies you can invest in. It came to my knowledge that I found out later, I could have saved $15,000 just by going with a government company.
Wow.
So that while whenever you hear a government plan of oh, you're going to get this credit back, they're charging you for that almost always. And so while it's a good thing, it's also a red flag, which is why the reason why it was a bad decision was because I made it super quick. And it was a friend of mine that sold it to me, which it's not like he did anything bad. He just was doing his job, and that was the pricing he was given. But ultimately, I went with a company that charged me way too much.
Maybe talk it over with a financial advisor before making that kind of big decision for anyone thinking about solar to see if it makes sense.
I have that's what I'm saying. Start giving it $50 a month, $100 a month toward some kind of IRA with a financial advisor, just so you have them in your back pocket for your entire life, in a sense, as long as possible. So, I wish I had someone that it ultimately came down to, just because it's your friend doesn't mean a thing. First of all, they're just working a job, and number two is don't make quick decisions like that. They should never make. My biggest regret is how fast I made the decision of oh yeah, this sounds great. Yeah, and it did sound great, but a lot of other things involved.
That's not a terrible mistake, because it still is an asset that's on your house. And if you ever sell your house, I'm sure you can get more for it.
Now, I didn't include the fact that I had just had to spend another $5,000 on taking it off the roof to build a new roof because they said verbally that they would actually cover that the first time, but then the company sold. So anyway, all that being said.
Proceed with caution.
Yeah, everything is proceed with caution before you sign a dotted line.
Yeah. Well, thank you for sharing that.
Yeah.
And, I'm happy that you were able to buy a house when you did, because that's an incredible decision that is a little bit of luck with timing, but it's a little bit also of, you don't want to sit on the sidelines too long in life. Obviously we're saying proceed with caution with big decisions, but also eventually sometimes you have to get in the stock market or get in the real estate market, and it might not be the absolute best time, but the cost of waiting on the sidelines is going to be worse than just entering and trying to make the best of it. So, I'm happy you were able to get in the real estate market when you did and enjoy that mortgage for as long as you can, because I don't know that we'll see those low interest rates again anytime soon, those 2 to 3%.
No, because again, with the house, like going back, so on a positive note, so back to the house, I bought it and then I refied it in the 2020. Instead of moving, I refied, and I have a 2.99 interest rate right now.
Amazing.
Like, it's going to be hard to ever move.
Yeah. It's so important to refinance when interest rates are low like that with debt that you have. And then on the flip side, and a lot of people don't know this, but for anyone that has annuities or CDs, it's important to refinance those when interest rates are high. So where we're at right now with Fed rates and mortgage rates being relatively high, 6%-ish, depending, maybe we have someone with an annuity or a CD from years ago at a low interest rate. They're only earning maybe 3 or 4%. If we refinance those into something that can pay them 6 or 7%, that makes sense as well. So it works kind of in the inverse as you would do with real estate refinancing. You can do that with your investments, and that's you can always benefit then. When interest rates are high, we can earn a little bit more. And so for anyone with an annuity or a CD that's a couple years old, I'd encourage you to contact us and we can see if it makes sense to refinance that.
I mean, let's just say I didn't have to pay the $30,000 toward the solar, and I had $30,000, and I'm technically paying $299 on that. But if I give that to you, and you're like averaging 6% on the low end, I'm making money with the loan. That's how the rich people do it.
No, really, they leverage their money. They borrow at low interest rates, and then they invest it and make that excess couple percent. That's how the rich people get richer. It's just the way it goes. And so overall, a couple tips for millennials, and you could share a couple, but, really first thing is getting a handle on a household budget. And that's something that you and your wife had already done.
Get an app.
Yeah.
Automate it.
You would recommend Rocket Money? Is it user-friendly?
I think Rocket Money is a really good one. It has that, I forget what actually the company it was before a Rocket purchased it, but it was that one that actually helped you find subscriptions that you forgot about. So I like that aspect about it. But honestly, I've used several. They're all kind of the same. They attach to your bank accounts so you can see your expenses. You do have to go in and maintain it to know the actual numbers. But at the end of the day, they still give you here's what you spent and here's what you earned. At the end of the day, you can kind of just go off that.
Yeah. Yeah, and that's step one, just getting a handle on your budget. And if you don't know where to start or you don't want to buy an app, contact me and I'll send you a spreadsheet that'll at least give you spots to put in all of the expenses you might have forgot about, like your cell phone bill or your Netflix, any of those little things.
And I would do that first, even before an app, because you're going to help them find the expenses that they're not thinking about.
True. Yeah. Very true. Another thing is obviously to fill up some kind of emergency fund, have a couple months of your rent or mortgage, those basic living expenses that you absolutely can't live without, have that accessible because you never know. Someone could lose their job. Someone could get hurt on the job. There could be a family emergency where you have to step aside from work for a couple months. Having that emergency fund is so important.
The emergency fund to me was $1,000. And then it was 1 month of expenses, and then and then you work toward 3 months of expenses. That's what I was kind of told. But ultimately, you're working toward that because just the other day I found out my son has a dental appointment that'll cost us $2,000. You never expect those things, and my wife was like, "Oh man, how are we going to budget for this?" I'm like, "We've already budgeted. We have the money." Now, obviously, you want to put that money back, and so that does suck. But it's not now I'm not having to take out a loan and pay interest on it. I'm giving myself my own loan. So you want to become your own bank in that way. So that's how I would suggest doing that.
Yeah, that's huge. And another tip is to take advantage of those tax-free accounts, which I know you're doing with your cash value life insurance, which is permanent life insurance. We're covering a couple needs there. We're making sure you're going to have a legacy for your kids, which I know is important. And then once we get that thing funded in the next 10 years, then you will be your own bank. You can borrow tax-free money from yourself, whether it be to fund one-time expenses, to give yourself a retirement paycheck. That's going to be huge for your future.
Yeah. At the end of the day, it's a Roth IRA, but and then you buy
on steroids.
And then you buy an insurance plan within it, and that put me at ease because if I only put $10,000 into it and then I die, my wife sees way more than $10,000.
Yep.
And that's the kind of idea behind it, and that gave me a lot of peace of mind.
Yeah, you want to leave behind life insurance to family members. You don't want to leave them your retirement plan. You want to use that to live on. You want to leave them tax-free assets that will pass seamlessly to them, and that's going to be your legacy for hopefully multiple generations one day. And then my last piece of advice for millennials would just be to get started and do it consistently. Even if it's $100 a month, let's get it set up so that it's automatically happening, regardless of what's happening in the market. If it's up, if it's down, it's actually better if it's down. And just make it a habit that you won't even realize after a couple months.
I know that you follow this advice, and the best advice I was ever given financially when I was younger was save. Don't count your savings after expenses. Put your savings above expenses. I know you've said stuff like that.
Yeah, spend what is left after saving.
And that's exactly how you be consistent with it. And it's hard. It's tough. Yeah. You might look at that and be like, "Oh, I had a negative month because of it." It was like you kind of didn't.
Yeah.
But at the same time, it's like, all right, we'll make it up the next one. Yeah. So ultimately, having that in mind will leave you consistent. If you do it the other way around, you will not be consistent.
Yeah, and I'm not here to tell people they can't spend their money and enjoy their life. That is not the advice I would give.
Enjoy a little less to enjoy a little more.
That is true. We really treat ourselves as a generation. I think, we could scale it a little bit back, save a little bit more, maybe buy one less coffee a week, make it at home that day.
I do feel like we've been lately in the last 100 years, several generations not thinking about their kids. They're thinking about their generation, how they're going to handle things and stuff like that, thinking that, like, I'm going to handle stuff for me, and if they can't, it's because they're irresponsible. Yeah. And I think what got us here to this point was not that mentality. The mentality of, I'm going to work for my kids. And so again, I'm not, everything I save is going toward my kids in one way or another, either to help me so that I can be there for them and not be a burden on them if I'm not able to work and so on and so forth. Or if I go, they have some money that I can help them. Either way, that's the investment. And I think every millennial should be like, I'm going to stop this trend of here and now, and I'm going to work toward that in the future. And I think
that's an amazing mentality there that I haven't even thought of. I don't have kids yet, but that's a really good mentality that I'm going to save in case I live too long or if I die too soon. Yeah. Either way, my kids are going to be okay.
Which is, again, a big reason why I liked your life insurance plan, with the Roth. It went into my mentality of what is my goal? My goal is for my kids to be safe.
Yeah.
And for me to always help them and not be a burden to them.
Yeah.
And that's
amazing. And you're doing it, which I commend you and your wife. You're really
we're trying.
You're getting on track, and that's one of the reasons I love working with millennials. Obviously, I work with people of all ages, but when we start now, we're going to lay the foundation that you're going to be set in every stage of the future. And I'm going to be right there watching you enjoy it because we're at the same age.
Yep.
And that's what's really exciting and rewarding about my job. And I love working with clients like you. Is there anything else you wanted to add today, Jeremy, before we wrap it up?
No, just I hope you understand that you have a really good way of communicating with people, and I love your track record too. Because it's not like you're like, I'm a young person, so I'm going to think like you. It's like, no, you have a business partner that's been doing this for years, and so you have both aspects. You see the strategies all around, which is why I think you have a really good thing going for you, and I'm happy to be your client.
Thank you. I appreciate that. So for everyone listening, thank you so much for tuning into another episode. We have a new episode of the Future of Finance podcast that comes out every other Thursday. And if you have a question that you would like to ask me or my business partner, or you'd like to schedule a complimentary phone call, Zoom call, in-person meeting, you can go to our website, union-financial.com. Click the schedule a meeting button and it'll take you right to my personal calendar where you can book a time that works for you. And for everyone else, we will see you on the next episode of the Future of Finance podcast. I'm your host, Marissa Wood. We look forward to helping you live a better financial future. Investment advisory services offered through Brookstone Capital Management, LLC, a registered investment advisor. BCM and Union Financial Services are independent of each other. Insurance products and services are not offered through BCM, but are offered and sold through individually licensed and appointed agents. The opinions expressed by Marissa Wood and guests on this show are their own and do not reflect the opinions of this radio station. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Investments involve risk and otherwise stated are not guaranteed. Past performance cannot be used as an indicator to determine future results. Any strategies mentioned may not be suitable for everyone. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for you. Before acting on any information mentioned, please consult with a qualified tax or investment advisor to determine if it's suitable for your specific situation. This program is designed to provide accurate and authoritative information with regard to subject covered. Index or fixed index annuities are not designed for short-term investments and may be subject to caps, restrictions, fees, and surrender charge as described in the annuity contract. Guarantees are backed by the financial strength and claims paying ability of the insurer. Please refer to our firm brochure, the ADV 2A Item 4, for additional information. Any comments regarding safe and secure products and guaranteed income streams refer only to fixed insurance products. They do not refer in any way to securities or investment advisory products. Fixed insurance and annuity product guarantees are subject to the claims paying ability of the issuing company and are not offered by Brookstone.